While the rest of the crypto market is glued to price tickers and waiting for someone to tell them what to do next, something far more important just broke across 3 different continents simultaneously, and almost nobody is connecting the dots. Iran just fired another wave of missiles, not at military targets, at infrastructure, specifically Amazon cloud infrastructure in Bahrain. And at the exact same moment, on the other side of the world, the United States Senate is stalling again on the very legislation that determines whether trillions of dollars in institutional capital are legally permitted to touch XRP. Coincidence? Or are these two things actually part of the same story? Here's the brutal truth that nobody in this space wants to say out loud. The macro environment and the regulatory timeline are not separate conversations. They are the same conversation. And today, we are going to prove it with data, with on-chain evidence, and with the kind of sober analysis that the emotional retail crowd simply does not have access to. Let me pull back the curtain. Welcome back to Ledger.Wealth.Network. I'm your host, and if you are new here, this channel does not do hype. We do not do price predictions disguised as analysis. What we do is forensic, data-driven deep dives into the systems and signals that determine where money flows before it becomes obvious to everyone else. Today's briefing covers the Middle East escalation, the Clarity Act bottleneck, Ripple's latest enterprise move, and what the on-chain data is actually whispering right now. Let's get into it. Let's start with the hard truth that very few people are willing to say. The reason XRP has not broken out yet is not a technology problem. It is not a use case problem. And it is emphatically not a Ripple problem. It is a permission problem. And the permission is being withheld deliberately, systematically, by a combination of geopolitical instability and entrenched banking lobbies who understand exactly what regulatory clarity would mean for their business model. Think about this logically. You have a protocol, the XRP ledger, that can settle a cross-border payment in 3 to 5 seconds for a fraction of a cent. You have Ripple, a company that just inked a partnership with Conver, one of the largest cross-border payment processors on the planet, moving billions in transaction volume. You have a regulatory framework, the Digital Asset Clarity Act, sitting inside the United States Senate, effectively complete, functionally agreed upon, being held hostage by bank lobbyists who are inserting last-minute provisions designed to kill competition before it scales. And now you have a Middle East conflict that is not winding down. It is intensifying. Here's what most people miss. Geopolitical instability is not just a mood. It is a mechanism. When oil supply lines are under threat, when the Strait of Hormuz becomes a chess piece, when cloud infrastructure in Bahrain gets struck by Iranian missiles, institutional capital does not get more aggressive. It gets defensive. It pauses. It waits. It requires certainty before deploying. That is the hidden mechanism that explains every confusing chart movement you've seen in the last 60 days. You see retail investors look at XRP hitting resistance at 1.37 and they say, why won't it break? Institutional capital looks at the same chart and says, we're not moving until we have legal clarity and macro stability. And that's a completely different conversation. David Schwartz has said publicly, and I'm paraphrasing here, that the XRPL is designed to be indifferent to volatility. It is the price of XRP, not the utility of XRP, that is being suppressed right now. Those are two separate things. And understanding that distinction is the single most important mental model in this entire space. The signal is clear, but only for those who are actually looking at the right data. The banks lobbying against the Clarity Act are not doing so because they think crypto is dangerous. They are doing so because they know exactly how efficient it is. And they are terrified of what a level playing field looks like. That is the foundation. Now let's build on it. Let's do the math, and I mean real math. Not the kind that gets you a motivational poster, but the kind that makes institutional treasury desks update their models. Cross-border payment volume globally, $150 trillion annually. That is the total addressable market for what Ripple's on-demand liquidity product is designed to service. Now here's where it gets interesting. Sitting inside traditional correspondent banking networks right now, there is approximately 27 trillion locked in Nostro and Vostro accounts, pre-funded, idle, dead capital sitting in accounts around the world just to guarantee that settlements can happen. $27 trillion earning next to nothing, doing nothing, because the existing system requires it as collateral. XRP's entire function, its design requirement, is to replace that pre-funded liquidity with real-time bridge assets. You don't need $27 trillion parked in Nostro accounts if you have a settlement layer that moves value in 3.5 seconds with mathematical finality. Now here's the math that the retail crowd consistently ignores. XRP's total supply is fixed at 100 billion tokens. Of that, approximately 55 to 57 billion are in active circulation. The rest is in Ripple's escrow, and the on-chain data from CryptoQuant shows that the vast majority of monthly escrow releases are being relocked, not dumped. Exchange reserves, according to Glassnode forensic data, are sitting at multi-year lows. The tokens are leaving exchanges. They are not coming back. Now, run the efficiency calculation. If a financial institution wants to move $10 million in value using XRP as a bridge asset, and XRP is priced at 1.37, you need approximately $7.3 million tokens for that single transaction window. But at $10, you only need 1 million tokens. At $50, you need 200,000 tokens. At higher price levels, the capital efficiency of the network increases exponentially, which means institutions can move the same value with dramatically less token exposure. This isn't a Moonboy fantasy. It is a design requirement. If even 1% of the $27 trillion in Nostro Vostro capital migrates to XRP as a bridge asset, that is $270 billion trying to move through a liquid supply of 55 billion tokens. Do the math yourself. And then consider this. The Forex market processes $7.5 trillion every single day. Every single day. If Ripple's ODL product captures a fraction of the daily settlement layer in global Forex, the demand pressure on XRP is not a wave. It is a flood through a valve that can only open once the regulatory rails are in place. The Clarity Act is not a nice to have. It is the valve. And right now, the valve is being held shut. Deliberately. By people who understand these numbers better than almost anyone in the retail conversation. This isn't a prediction, it's a requirement. The math doesn't lie. And if you have a problem with these numbers, you don't have a problem with me. You have a problem with the laws of finance and physics. Now let's talk about what the smart money is actually doing while retail investors are refreshing price charts and asking ChatGPT whether $1.40 is going to hold. First, Ripple's partnership with Conver. This is not a press release. This is a production-level integration with an enterprise payment processor moving billions in cross-border volume. When Ripple announces a partnership of this scale, it means their legal team has already confirmed the jurisdictional compliance requirements. It means the technical integration is months in the making. It means this is not a pilot program. It is deployment. Ask yourself, does a company of that size sign an enterprise integration agreement without absolute legal certainty about the asset they are building on? Absolutely not. They don't gamble. They position. Second, watch what's happening in Japan. The Financial Services Agency in Japan, one of the most methodical regulatory bodies on the planet, has been quietly building out a digital asset regulatory framework that explicitly accommodates XRP's classification as a non-security utility asset. The Bank of Japan is not moving impulsively. They are positioned. Third, look at the ETF landscape. While the public narrative around crypto ETFs is dominated by Bitcoin, institutional custodians, including Fidelity, Franklin Templeton, and others, have been building out infrastructure for XRP exposure vehicles. These are trillion-dollar firms. They do not build infrastructure for assets they don't intend to service at scale. They don't build the pipe and then decide not to turn on the water. Fourth, Hidden Road. Ripple's acquisition of Hidden Road, a prime brokerage servicing over 300 institutional counterparties, was not a vanity purchase. Prime brokerages exist to provide leverage, custody, and clearing for institutional clients. Ripple now owns the infrastructure that lets institutions use XRP at scale inside a fully compliant framework. That acquisition was quietly one of the most significant moves in this entire industry, and it received a fraction of the coverage it deserved. And yet, while all of this is happening, the Clarity Act is stalled. Senator Lummis and the Banking Committee are saying right before Easter break, right after Easter break. They've been saying some version of just a few more weeks since December. I want to be measured here because I think this channel owes you honesty. The delay is real, the frustration is legitimate. But here is what I want you to hold on to. The fact that banks are lobbying this hard against the Clarity Act is itself one of the most powerful signals in this space. You do not spend millions of dollars lobbying against something that doesn't threaten you. The resistance is the signal. The harder they push back, the more they've already run the numbers. Institutions are not panicking. They are accumulating, integrating, and waiting. The difference between institutional behavior and retail behavior right now is the difference between a chess player and someone staring at the board not knowing it's their turn. Let's talk about the specific catalysts and what the realistic timeline looks like. The Clarity Act markup, according to the Senate Banking Committee's own statements, is targeting either the week before Easter or the first week of May. Now, I want to be direct with you. I have said on this channel before that timelines in Washington are political, not functional. They slip. They have slipped. And if you've been in this space since December listening to just a few more weeks, your skepticism is earned. But here is what has changed. The deeper we get into 2025's legislative calendar, the more the window compresses. The midterm cycle begins pulling attention away from financial legislation by mid-year. That is not a theory. That is how the legislative calendar has worked for decades. If the Clarity Act does not clear committee before summer recess, the probability of passage before the end of the year drops significantly. That compression is not a threat, it is a forcing function. And that is actually good news because it means we are approaching the point where delay itself becomes politically untenable. On the macro side, the Middle East situation is the wild card. If the conflict escalates and the on-chain sentiment data, the missile activity, and Iran's flat rejection of ceasefire negotiations all suggest it will, we are likely looking at continued downward pressure in the near term. A new interim low for XRP in the $1 to 110 range is within the range of realistic scenarios. I am not panicking about that. I am planning for it. The window is not closed, but it is compressing from both ends. Regulatory clarity on one side, geopolitical pressure on the other. And in the middle of those two forces sits XRP, the only digital asset in the world already embedded inside live, production-level, cross-border payment infrastructure. Once the valve opens, the flow will be immediate. The countdown has begun. Here is the question that I want you to sit with seriously. What is the cost of being late? Not the cost of being wrong, the cost of being late. If you are watching this video, you already know more about the XRP ecosystem than approximately 99% of the global investor population. You understand on-demand liquidity. You understand the Clarity Act. You understand what the XRPL is designed to do in the global financial architecture. You have done the work. The question is whether you are positioned proportional to your knowledge, because here's the reality of how these markets move. The explosive phase of any asset cycle does not happen over months. It happens over days, sometimes hours. The institutions that have been quietly building custody infrastructure, signing partnership agreements, running compliance audits, they do not announce their position when they take it. They announce it after the trade is already done. Glassnode data consistently shows XRP exchange reserves at multi-year lows. The tokens are leaving the exchanges. They are not coming back. That is not retail behavior. Retail doesn't move tokens off exchange at scale. That is custody behavior. That is someone preparing for an event. The door is closing. Not because I am saying so, because the data is saying so. Once the Clarity Act passes, once the regulatory gate lifts, the race to position will not be orderly. There will be no second signal. There will be no polite cue. The informed investor does not wait for confirmation. The informed investor is the confirmation. You already know what you need to do. Let me bring this home. Today we covered a lot of ground. The Middle East conflict is not a distraction from the XRP story. It is part of the XRP story because macro instability is the primary mechanism suppressing institutional deployment right now. The Clarity Act is delayed but not dead. And the compression of the legislative window is itself a signal, not a setback. Ripple's partnership activity, its custody infrastructure, and the on-chain exchange drain all tell the same story. The architecture is being built. The rails are being laid. The capital is being positioned. The math does not lie. The $27 trillion in nostro vostro liquidity is not going to sit idle forever. The $150 trillion cross-border market is not going to keep running on Swift indefinitely. And the people who understand that, the institutional custodians, the prime brokerages, the sovereign funds quietly filing compliance paperwork, they have already made their decision. Now you have to make yours. If this kind of forensic data-driven analysis is what you come here for, subscribe, share this with one person in your circle who needs to hear it, and drop the word Ledger in the comments so I know who made it all the way to the end. In a market fueled by emotion and noise, we thrive on data and composure. Stay patient, stay rational, and as we always do here, we don't wait for the future, we plan for it.